call
Yeah.
here now.
Yeah, I think we should be good. I can
Okay.
go through the first few slides.
All right. We'll see what I retain. I may have made some edits, but let's
Okay,
see.
no worries.
Is
All
it
right, well, welcome everyone. This is the Be Your Own Boss Bowl workshop. And here you can take a moment and scan the QR code. This will give you access to our resources here. You can see the templates, submission examples, and some tips, eligibility policies, workshop video recordings, and our slides, as well as the judges' scoring rubric. So take some time now to scan the QR code on the screen. All right, should be good.
right?
Okay. And then once you guys scan the QR code, you guys will have access to the Google shared folder. So once you get in, here is what the financial projections folder will look like. If you have any issues getting in, let me know or send me a message afterwards and we can help you with that as well.
Right.
And then there's 3 submission requirements for financials. That is the 3-year income statement, the financial slide in your pitch deck, as well as financial section in your executive summary. That's a summarized key points from the 3-year income statement and pitch slide, revenue model, profit margin, key indicators, financial resources you have and need, cost to launch, and other major assumptions. So those are the 3 submission requirements. I'm sure Michael can go into more detail within that. And if you have any questions for him, don't hesitate to ask. And next, I'm going to hand it off, or no, there might be more slides.
Nope.
Sorry.
That's it. That's it for now.
Okay, amazing.
Yeah. Oh, that's all the fun housekeeping things. All right. Well,
Yeah.
welcome everyone to the BYOBB. I want to make sure I get the next B in there. Or just it sounds like people are trying to have fun having some alcohol. So I'll give you a brief introduction of who I am and why I'm the agenda and objectives and benefits for the folks participating in this session, and we'll dive right into the content. So my name is Michael McBride. I'm a senior manager at Deloitte, which is a large accounting and professional services firm, consulting, tax, all that good stuff. I work in their audit insurance group there, and in that group, I work a lot with, or I've led a lot of IPOs, and a lot of those IPOs, initial public offerings, are taking a growing private company into the publicly traded on the NASDAQ or the New York Stock Exchange. So I've seen a lot of transformation with those companies, and I work now a lot with emerging growth companies and startups in Philadelphia. When I'm not doing all my accounting and auditing work, I like to spend time with my family. I have 2 boys who are pictured there, and then my wife is expecting our third at the end of May. And then if I find some time, I like to exercise and read a little bit. So I appreciate everyone joining me today for this session. So objectives and the benefits of what you're going to get out of this session. So we're going to cover what is a P&L, a profit and loss statement. Why should you have one? What does an income statement look like? And then specifically for you, as you're building out your projections, your forecast for your startup or your entrepreneur, how can I develop my income statement and my forecast? Where do I want my business to be in 1 year, 2 years, 3? And how can I link those drivers of the projections, the growth assumptions, to my projections, to my forecast? We'll talk about developing in year 1, year 2, year 3, and then how you can incorporate that into your actual pitch. And then we'll proceed from there. So here's the very similar to the objectives that we just covered. So maybe I'll pause for a second, and if anyone wants to use the chat feature or can come off mute, what is your level of familiarity with income statement or a profit and loss statement. So feel free to come off mute or put your answer in the chat box.
Hello, can you be able to hear me?
Yes, we can hear you great.
Hi, I'm Smiley.
Hi,
Um,
Smiley.
First, I wanted to say congratulations for the third
Oh, thank you. Thank you.
child.
Thank you. Yeah,
That's a big deal.
yeah.
And I wanted to say I don't know much about P&L.
Sure.
I've heard or I've heard it being referenced, but I don't know much about it.
All right. Well, you're in the right place. Thank you for sharing that. Thank you, Smiley. Is anyone else here a seasoned expert? Is an accounting major or a CPA? All right. If not, well, I'll assume everyone's kind of at the same level as Smiley here. We're all here to learn and to upskill. So session, please feel free to pause me. I'd like this to be an interactive program here. So feel free just to stop me. So this is a simple profit and loss statement or an income statement. And what it shows in that first column, moving from top to bottom, are the account categories or the financial statement line items. So the top is your sales or your revenue, broken out by two different categories. So in this particular instance, they sell chips and sell lemonade. Makes a lot of sense to me. And then underneath your sales, you have your cost of goods sold. So those are costs or expenses that are directly associated with the production and delivery of the good or the service. So in this instance, to sell the lemonade or to sell the chips, they have these specific costs. And you have your total cost of goods sold, which sums all those up. And underneath that, you'll see a metric, which is a profit metric called gross profit, which is your sales, your top line, minus your cost of sales, your cost of goods sold, cost of services provided. You'll hear it referred to different ways depending on the nature of the company. Depending on your business, gross profit and the gross profit margin, which is that figure expressed as a percentage, can vary very widely. For example, if you're in a software as a service model, you may have a gross profit that's upwards of 75 or 80%, meaning you have very low cost of sales and a very high margin. You have a high profit. Alternatively, if you're in the retail space, or I have some clients that do security services or landscaping services, they have a lot lower margins because not only are their costs the labor for the people to, let's say, do the landscaping, but it's the equipment that they're using, mulch that they're putting, which decreases your profit because your expenses are higher. That's how you get to your gross profit. Then underneath that, moving again from top to bottom, are expenses, and that stands for selling, general, and administrative expenses. These are your other operating expenses, and you see here things like bookkeeping, the accounting side of things. If you're the CEO, your salary, your wages would be captured in there, advertising expense, marketing expense, all captured in the selling, general expenses. That then is summed again. And then your bottom line, you'll hear the term again, the bottom line is your net income, which is your sales minus cost of sales equals gross profit minus your selling, general, and administrative expenses. At the bottom here, if you see a profit margin calculated, and this metric is taking your net income divided by your total percentage. So I know that was a lot. I'll pause there. Feel free to ask any questions or to use the chat box.
Can you just repeat that last section one more time to let it sink in?
Yeah, sure. On the metric part or the SG&A part?
The SG&A part, please.
SG&A, sure. So these expenses relate to selling, general, and administrative, and these are operating expenses that are not directly associated with the sale of the good or the service. So let me use an example. When you mention between cost of sales and SG&A, I'll go back to that landscaping company example that I have. If you are a landscaper and you're a gardener, you're going to the client site to do the landscaping, you're putting down the mulch that you're using, or you're planting the flowers, all those costs, that employee's hourly rate, as well as the mulch and the flowers, all goes up to cost of sales because it's integral to the delivery of that service, those landscaping services. However, that company probably has a billboard with their brand name on it, or perhaps they have an accounting function back in the office, or a sales executive. Those costs for those people or for that marketing expense, those expenses go in SG&A, those selling, general, and administrative expenses. So if you have folks who work in your legal department, or as you grow, your HR department or your IT department, those salaries and wages go down in your selling, general, and administrative expenses. Or if you want to pay to get a billboard or to advertise somewhere, the expenses go in selling, general, and administrative expenses. So that's the distinction there. Really, the cost of goods sold or cost of services provided are directly linked and associated with the performance of the service that you do. Does that
Yes,
help?
thank you. That's
Okay.
clear. Yep.
All right, great. All right.
So then if somebody was making the lemonade in this situation, would that go as direct labor under cost of goods sold?
Yeah, that would. Exactly right. That's where that would go. So that's not shown here. This looks like it's really focusing on the materials in that simplified example. But if you had employees who were dedicated to serving those to the manufacturing of the lemonade or the service of it, that would go in your cost of sales. That's exactly right.
Okay,
Right?
thank you.
I also have a question. I know that
Sure.
in net income statements, there are like absorption costing, net income statements and variable costing. Which one is like the most popular? And I think there's also like GAAP requirements. Which one would
Yes.
be the most, or which one is GAAP, like, I guess, yeah, follows GAAP rules.
Yeah, Maddie, that's a very specific and excellent question. I think you're getting at inventory, right? And the relief of inventory and those types of expenses. If we want to chat afterwards, I'm happy to have all of your financial statements, including your income statement here, should follow GAAP. It should be in compliance with GAAP. Now, from time to time, GAAP, which stands for Generally Acceptable Accounting Principles, does allow for different options based on the company's accounting policy. And there are different inventory methodologies, and there's different costing methodologies associated with inventory, like and to that point, the variable costing or direct costing methods. We talk about that separately. That may not be as applicable to everyone in this group, but excellent question.
Okay, thank you.
Yeah, sure. All right. I'll move on here to the next slide, and maybe we already covered some of this stuff already, but here's another view. Now, in this view, it's presented a little differently, but still gets the same message across. You have your sales or your revenues at the top, and then your expenses. So you see cost of goods sold, then you have your administrative salaries, rent. So if you rent an office, utility, interest expense, if you have any debt or a line of credit, other losses, bad debt provision, and then depreciation. So let's say you have a laptop that you're using for your business, record an asset for that laptop, and then depreciate or take the expense for that laptop over a period of time, and that gets captured here in that depreciation line item. So a P&L is typically used for two purposes. The first view is, okay, well, how did my business do this past year, this past month, quarter, whatever the period is that you're producing a P&L for? It's for a period of time. And then the other is forecast it to see, okay, well, where do I want my revenue to be? What do I think my expenses are going to be? And that's super important for early growth and early, so they can have an accurate or at least a reasonable forecast and can communicate to potential investors what the growth potential and opportunities are. So what it shows, how much revenue are we bringing in? Where are my costs coming from? Are we profitable? That's always a good thing to know. Identifying plan for cash needs, we'll spend more time on that. What does the future look like? One thing that's interesting that you can do is you can look at trends of your income statement month to month or quarter to quarter, and you can say, oh shoot, this particular month or this particular quarter in XYZ cost. What caused that? And then you could drill in and be more informed as a leader of your business. And then you can use that information to figure out what changes could or need to be made and what impact will that have. So these are some key components of a profit and loss or income statement for a startup, and we covered some of this already. So top line sales, the company expects to receive, cost of sales. I kind of drilled into this already, but costs are directly associated or related to the sale of those goods or those services. Gross profit or gross margin, the revenue minus your cost of goods sold. Your operating expenses, that's the same thing as your selling, general, and administrative expenses, exact same description. So it's the other expenses that aren't associated with producing the actual sales. Term called EBITDA, which is earnings before interest expense, your taxes, depreciation, and amortization. This is generally a key metric used, a key profit metric, and it helps show the actual financial health of the business and the operational health of the business. Occasionally, companies or investors will look at, well, okay, you have a lot of taxes or maybe a lot of and those are decreasing your net income because they're higher expenses, but they're not good indicators of the financial performance of the core operations of the business. So they'll use this operating profit line to normalize and get a more accurate view in their sense of what the financial health of the business is. There's metrics here too. So this would just be interest, taxes, depreciation, and amortization, generally not relevant from a startup perspective. And then again, getting to that bottom line, that net income line here at the bottom. All right. So there are some key metrics associated with the profit and loss statement, and I want to spend some time demystifying them. When we think about revenue, we might hear a lot of these terms, and there are a lot of acronyms too, the CAC, customer acquisition cost, customer lifetime value, attrition and retention, diversification of your geographic segment groups, ARR, annual. So I want to spend some time here. I'll double click I'm gonna pause. I give you all a second just to read through these, and then I'll provide some more context and color if there's any here that you folks want to talk more about. So I'll pause here briefly. All right. So what I see a lot in the marketplace that venture capital firms and private equity firms are focused on are the top left and top right one, the growth rate for revenue, very critical. What is the year-over-year revenue growth, the top line growth? Is it 2% or 3%, or is the company expecting to grow at 10%? That's a key metric. And then the other one is the ARR, that annual recurring revenue. This is a huge focus for SaaS companies or software as a service. And what it does is it allows for investors to get a better picture of the valuation by understanding, okay, they have recurring revenue. So every single year, there's a base revenue that the company expects to earn because they've entered into longer term contracts or locked in customers and have an annual recurring revenue base. So for example, if you were selling a subscription that someone pays for upfront for a 12-month period, you have a more accurate ability to forecast your revenue because that is locked in for 12 months. Another item I want to highlight here is retention on the bottom, the opposite of attrition, and a company's ability to retain customers. I think I remember in college learning the 80-20 rule. So of your customers generate 80% of your sales, and being able to retain key customers can be super helpful. I actually had a client of mine had two different, I'll use this landscaping company, had a hardscaping side where they would do the construction of, let's say, the wall or the pool, and then they had a maintenance side where they would do the annual or the recurring maintenance work, like the lawn mowing or the flower planting or the pruning. And what they realized is these two types of revenue streams weren't coordinated. So they would do these construction jobs where they would develop a pool or build would never translate that work into the maintenance side. So if you have a business that has some sort of installation or service model, and you're able to connect your aspects of your product or your services and get them to be more invested in the business, you'll have higher retention and increase your revenue. So I'll pause here on this slide. What questions do you have about some of these key revenue metrics? Do any of these stick out to you? Do any of these, are they super applicable, or you think they could be applicable to your company?
Something that sticks out for me is retention. I
Mm-hmm.
had a job last year, and it was in sales. And one of the biggest things for sales is having that loyalty, having that retention. So retention definitely stuck out to me.
Yeah,
And
that's
growth
great.
rate, of course.
Mm-hmm. Thank you, Smiley, for sharing. Absolutely. All right, so now we're going to talk about, and we mentioned these a little bit already, but the key profit metrics. So depending on the type of company that you have, the type of business, you may want to emphasize to potential investors different profit metrics depending on what's more important. So for example, if you're a SaaS company, software as a service, you may want to really focus on your gross profit or your gross margin. Or you could be in that operating income land where it's your minus your operating or your selling general administrative expenses. Or maybe you want to also show that your bottom line net income, or perhaps it's a hybrid with that EBITDA before interest, taxes, and depreciation and amortization profit metric, and figuring out which one best showcases the financial performance of your business, and then highlighting that will put you in a better position with investors. All right, and the third key metric, it's not necessarily on the P&L per se, but it's very critical from a startup perspective, and that's cash. Cash is the lifeblood of any startup, and a lot of time to your next round of the funding, whether it's a family friends, a pre-seed, a seed, or a Series A, and then after that, cash funding is super important. So the first metric I want to highlight here is your operating cash flow. That's just the cash that the business is able to generate on its own. So that's the cash from your sales that are coming into your business, less any of the expenses that you are paying cash for. Then you have, which subtracts out your capital expenditures. And then you have your cash conversion cycle. This is more specific, and maybe, Maddie, this is one for you, so maybe not applicable to all the folks on this call, but the big one that's most important is the cash burn rate. And this is basically the runway, or how much time does my business have before I run out of cash. This is super critical for any CEO or founder, entrepreneur to be aware of, as this is the indicator of how long can I keep this thing going. So I can do a quick example here. Suppose a startup has the following financial data: $100,000 of operating expenses, $30,000 of revenue, and $600,000 of cash. So maybe they already went through a nice funding round there. So the gross cash burn rate would be $100,000 per month. Your net burn rate is only $70,000 because you have that monthly revenue, that cash coming in. So it's 100, which is the monthly operating expenses minus the monthly revenue, and then the runway. This key metric is, okay, if I have $600,000 in the bank, divided by $70,000 net burn rate per month, I have 8.5 months until I've exhausted all of my cash. So if you don't know your cash burn rate currently, take a screenshot of this, write this calculation down, calculate it. It's very important for being able to determine how much time left startup. What questions do you have about the cash key metric? And feel free to put it in the chat or to come off mute. All right. All right. Talked about what's a profit and loss statement. What are some key metrics and key things that we should be aware of as we're developing it. Now we're going to move into how can I develop my assumptions and tie them to the financial projections. So your numbers in and of themselves in a forecast don't showcase the entire story. It's not just a spreadsheet with random numbers and random growth rates. You need to be tying those figures, those assumptions, so that maybe you have a 5% growth rate year over year. Well, how do you expect to achieve that 5% growth rate year over year? Are you going to upsell your current customers or increase your sales in a new market, a new geographic space, to sell a new product or a new service that wasn't being sold before? And trying to tie those types of actions, those discrete actions, to the assumptions that you're making in your forecast. And it's not just on the revenue, but also on the expense side. So as you're forecasting, let's say your revenue to grow, because maybe you're going to hire someone to help with sales. Well, shoot, I need to factor in their increased payroll into my forecast. So you don't just get the benefit of the plus side of their selling expertise, but you also have to think about, okay, well, shoot, there's their salary and wages, there's the taxes, there's the health insurance, all those other things that get factored into your forecast that you got to be mindful of. And you can develop your forecast in many different ways. I would think of it as a living document that you can revisit on a monthly or quarterly basis, whatever works for you, and make sure that you don't just have the numbers, but you have that commentary there. And whether it's in comments in Excel or footnotes, whatever works well, that you can make sure you're managing to. And one thing that you can do to help in your assumptions, and we'll talk more about this, but you can use peer companies or other folks in your industry if you feel like you do align with an industry to get some insights on assumptions. And maybe you're not at the same rate, but some of the things that they're thinking about. So I wanted to pause myself here and ask this group, for those of you that maybe have a forecast or are thinking about or putting it together, if you could come off mute and share, what types of assumptions are you making? And feel free just to come off mute. Does the silence mean that no one has any assumptions for their startup already? Operations.
I can go. So I am my company, we make mead, like the honey alcohol.
Oh, hell yeah, that's good stuff. I'm not sure how
Yeah.
I'm supposed to say that on top, but yeah, that's cool.
Yeah, and so my assumptions are like the cost of materials,
Mhm.
the raw materials, and then packaging costs and
Yeah.
the sales, like how much I'm gonna be selling, insurances,
Yeah.
just like equipment, advertising costs, pretty much everything. But I did like, look up the costs of the things, and some of the things I've already bought or paid for. So that's what I have.
It's great for sharing that. And I do want to try the mead, Sophie, if you have any. I think that'd be awesome. And as you start to incur actual costs, you can use them in your forecast. Like, okay, I now know that my per unit cost is X. I can factor that in on a go forward basis. I think that's always super helpful to use actual costs to inform your forecast, and you can develop a per unit. So, your instance, for every pint, and is it pint? Is it glasses? I don't know, but for every pint of mead I produce, it costs me 23 cents. So if I want my sales to go up by X, by selling more mead, number of pints, I can just do that multiplication and get the 24 cents or whatever it was. And it helps with your forecasting. That's great. Excellent. Does anybody else want to share what assumptions they are making or what they think they should be making?
So I have some assumptions as well. For my particular idea, I have several products that I'm trying to sell or rather resell in a one singular brick and mortar. So
Mhm.
just trying to figure out how I want to price those items, especially at the different locations, and how prices may vary. Um, and just assuming like if one location, if the product's there, how high range or percentage wise compared to the normal average price of that product. And then how I should price it. Is my prices too low? Are they too high for particular areas?
Sure.
Trying to assume, like you're saying, the forecast of everything.
Yeah.
Yeah, so that the health part and how much the startup would be, and most importantly, like the week by week or monthly, um, the monthly income for everything, because I'm trying to hit a quarterly goal
Yep.
for my business, for the, of course, annually goal. And like you were saying, the 5% growth is something that I've been trying to think and assume how am I going to get clientele and influence with my product.
Yeah. You made a good comment there about the locations, and I think an interesting data point. If you go to a restaurant wine, the markup on the wine at a restaurant is always wild to me. But you can go to a different restaurant, let's say in Fishtown, that sells a bottle of wine, and that same bottle of wine at a restaurant in Rittenhouse Square will be significant. It's the same bottle of wine, but it'll be significantly more expensive to buy the bottle of wine in the Rittenhouse Square restaurant versus the Fishtown location. And it's all because of the geography or the neighborhood and the market. So knowing not the location of where am I market do I have can help inform your price point, even though the cost for those is the exact same. It's maybe a $25 bottle of wine. Maybe in Fishtown it's marked up to $50 for a sale, but in Rittenhouse it's $80, right? So those are great things. Absolutely. Thank you for sharing. All right. So we talked about this a little bit, but can you use to help validate your assumptions? I think using the historical performance, the actual cost that came in, I can use that, or the actual revenue that came in that I was able to sell my goods for, use that in your forecast. The industry outlook. So if you're operating, I'll use this landscaping industry example, there are reports that experts put out that say, okay, for this industry, for landscaping services or for consumer tech or for automobiles, we think the growth rate over the next 5 years will be X, and it's because of these factors, and the industry looks like it's going in the right direction or it could be going in the wrong direction. It's a shrinking industry. Use that. That doesn't mean you're on a track along the industry, but it gives you things to think about. The macro, you'll see in the news a lot of turbulence in the marketplace around the tariff. So how could that potentially impact my business? Does it? And do I need to incorporate that information into a forecast? And then market pilots. So if you're going to do a new product or a new service, should I pilot it in a region and see how that does? And then that can I extrapolate that performance to other places? All right. So we've talked about some types of assumptions, and I appreciate everyone sharing. Simplified example, if revenue is based on the number of subscriptions, right? It's determined on the number of people you can reach, demographic, geography, channel, conversion percentages, and then the number of months per subscription. So the longer you can get people to subscribe for, the easier it's going for you to be to forecast your revenue. When you're developing your assumptions and developing your forecast, it's got to be supported by a rational business strategies. Now, that doesn't mean you need to be conservative. You can be aggressive, but to the second bullet point here, it's got to be realistic and attainable. if I've never sold anything, I'm probably going to have a hard time forecasting $10 million of sales in year one. It's not realistic. So making sure you have that sanity check, take a step back and challenge your own assumptions, or get someone else, a friend or an advisor or a colleague, and have them try to poke holes in it. Have them ask questions and find contradictory or disconfirming evidence, and then you can go back and enhance it and tweak to what we talked about a few slides ago. Is you're forecasting your assumptions, so you're not married to them at any given point in time. The another bullet point down below, the gross margins should be in line with the industry. And we talk about gross margins or your net income. If you're in an industry, let's say that software as a service, and your gross margins are only at 20%, but the industry is closer to that 75 or 80%, well, holy smokes, you better take a look at what's going on there. Or maybe if you're in a retail industry, margins at 80%, when in retail maybe it's closer to 25%. Well, how are you think you're going to achieve such high margin based on your industry, and what makes you unique? Maybe you can substantiate it, and if you can, that's great, but just make sure it's supportable. And then based on all this information, and we talked about this already, what are your cash shortfalls? What's that cash burn rate? Right. So this is an example of a year one forecast broken out by quarter to get you to the full year. And this can be helpful from a planning and a growth perspective. And that this income statement looks a little bit different. It breaks out variable costs, which is generally tied to that cost of goods sold. Very similar figure here, but basically what it's saying is for every unit that I sell, what's my cost associated with that unit? So in this instance, if I'm paying a sales commission for every unit that I sell, I'm going to have to pay a commission as well. So they're showing that here from this forecast perspective, that sales commission line. Then you get to a contribution margin, very similar to a gross margin, and then below you have your selling, general, and administrative expenses, the compensation, salary, that's a big portion, and then your operating expenses, facility costs, maintenance costs, depreciation, marketing. And this gives you some context here of what type of salaries to assume from a cost perspective, without benefits, with benefits, and done by quarter. Now you have that supported underlying detail. However, when you're developing your pitch deck, keeping it more succinct and high level will be helpful to communicate the revenues, the expenses, and here the profit metric that they chose to use was gross profit. You can use operating income, net income, whichever metric you think best communicates that value. So you're able to show a 3-year forecast. You can show prior year if you've had sales or activity in the prior year, or maybe a current year stub period. Include a revenue driver if that makes sense for your business. So for example, of using subscriptions, prior year you had 100 subscriptions. Year one, we're going to have 1,000 subscriptions. Year two, we're going to have 3,200 subscriptions. Whatever that key driver is, highlight that. It's always helpful. And then immediately connects the reader, the user of this information, from the driver to the revenue growth, so they can see where you're generating that revenue from. To use decimals, and I think to the earlier point, that this tabular simple format is definitely helpful. And yeah, here I just verbalize this, but using number of subscriptions, conversion percentages per subscriptions per month, whatever works for your startup. And if you don't have a clear driver, that's fine too. a key question that you're going to have is what you're going to be doing with the funding you would receive. And would that expedite your growth trajectory? So for example, without the funding, if you're assuming, well, I can only grow from 277 sales to 7,000 sales from 2021 to 2022. However, if I get the funding, I can hire another salesperson. Would that adjust then your revenue growth? So be prepared to answer those types of questions. And then also, as you're sketching out your forecast, don't be alarmed if, oh shoot, in year one, I'm forecasting a loss. That's okay, completely expected. I mean, you see large public companies still have losses, but they generate cash flow and have maybe an EBITDA positivity, which keeps them in business. That and probably a lot of outstanding debt. All right. So using the below format, you can translate your assumptions into a 3-year forecast, and this will be your summarized version. I'll pause here again as we've had this discussion. Are there any assumptions that you think you could be making for maybe a year 2 or a year 3 that would be different from year 1? So something in the out year.
Yeah, I definitely feel like in terms of assumption for year 2 and year 3, um, it's kind of, I was even talking to a teacher and they were saying usually as an entrepreneur, year 1 is usually the roughest, and it's kind of given that you most likely will take a loss, but if you continue to grind um, and work on advertisement and marketing and if it's a product that hits a pain point, definitely there would be there would be an assumption that year 2 and year 3 would come more with brighter days, I guess you can say. Absolutely.
Right. Thank you for sharing. Perhaps a distinction between year 1, your plans to only sell one product, but in year 2, you want to release a new product, and that would then increase your sale potential. So being mindful of how you can embed that driver or the types of drivers into your growth assumptions can be super beneficial for you. All right. So in summation, don't leave out cost. That's a bad way to get tripped up. So be as thorough as you can, put in all the costs. So advertising, utilities, internet, put it all in there, track it. That'll make your forecast more realistic and more accurate. Then connect those assumptions, make sure it's consistent with what your business plan is. When you take this step back, realize, okay, they are estimates. They don't need to be dollar for dollar spot on, but are they reasonable? Investors will always discount your projections, and that means when they do any type of evaluation, they will apply a discount rate or a premium to inherently capture the risk of the achievability of your forecast. So they embed that in their models. So to the earlier point, don't be conservative. The investors are going to be like, oh, there's no way you can hit 10%. We're only going to assume that again. They'll capture that in their models. So it's important to know some of their behind the scenes sausage making, so you don't go too conservative on your own and they're going to discount it further. Right. So I know we're coming up at the top of the hour here. I'll pause again. What questions do you have about the income statement or developing financial projections or linking them to assumptions? I'm definitely happy. I can include my email here in the chat if anyone wants to reach out to me to talk more, to grab a coffee. Happy to do that. And then Carly, if there's anything that I missed that you wanted to add from a program perspective.
Yeah, thank you. I'm just gonna see if I can share my screen
Yeah,
quickly.
I'll stop sharing.
Hopefully you guys can see. Ooh. Just quickly wanted to remind you guys that there is 2 weeks to go. So make sure you are utilizing the startup tree, mentors, Temple SBDC, the library, and Blackstone Launchpad. Make sure to attend the final workshop next week. Do your research. Make sure to validate those key assumptions, and then make sure to get feedback. Like Michael said, reach out to people, mentors, your prospective users and customers, industry experts, and all that. I also have for you guys the QR code for the FLDP. So if you guys need those points to scan that QR code, hopefully you guys are able to see that on your end. And that should be it from me. But if you guys have any questions, feel free to unmute, ask in the chat. But appreciate you guys coming on, and next week will be our last workshop.
Hey, Carly, I did put this in the chat, but the deadline is the 27th.